What's really good? What's really good? We back at it again. Obviously, something changed. Your boy done got the little trimmy done. Hair gone, gone. You feel what I'm saying? Which is long overdue. You feel me? But besides that, actually I need to do my numbers this week. But this week, I believe Signals finished with a 70%. I believe I finished with an 80 or 90% overall this week. So give all praise and all glory to God. Also had end of month, I believe last week, finished with another 80% win rate. Give all praise and all glory to God, Jesus Christ of Nazareth, the one and only true God. But besides all those announcements, going into today's video, I'm going to be within one video. It's not going to be too long. And even if it is, be disciplined, lock in, and learn. But in this video, I'm going to be basically rebooting all of my older YouTube videos that were more focused on the index markets, futures markets, etc., etc. So rebooting all of the strategic stuff with supply and demand, primary standard liquidity strategy, any other concepts, especially when it comes to contracts and how you place orders and everything like that. Granted, I won't be on my exact prop firm's platform, but I will be on my brokerage's platform. But same thing, same thing. You feel what I'm saying? It's going to be very informational. You're going to learn a lot because a lot of my older videos, I don't know what I was doing. So I just want to get a fresh reboot so I don't got to so no one has to see all my older stuff at the moment and be educational, help everybody out as I've been trying to do ever since I started everything. It's about to be a year since I've had this YouTube channel, Instagram, all my media companies. Give all praise and all glory to God, and I appreciate every single one of y'all that's stuck around since the beginning. But besides all that, let's get straight to the video. All right, so first things first, if you ain't in the Discord, tap the link in the bio and come join the family. Get consistent signals and streams from my brother every single day. But go to the charts. First things I want to go over is what is futures and the contracts, position size, risk management wise, everything like that before I get into strategic stuff, which isn't going to be super long. It's going to be super quick and brief. It's not going to be whatever. All right. So futures, just like any other trading asset, basically you are buying and selling at a certain price leading up to a predetermined price that you are being allowed to by the brokerage, prop firm, whatever. I have a live account, I have a live brokerage, and I have a funded account from a funded prop firm, everything like that. All right. Which you can use either one. That's completely up to you and your financial stability. All right. Now, the differences when it comes to futures compared to options trading, before I get into the contracts and the risk management wise, is it's a little bit different from options to an extent. But the main difference with futures is the markets to an extent. With futures, there are multiple different types of futures. You have futures commodities like gold, platinum, silver, whatever. You have futures currency. So that would be like Forex basically. So like Euro USD, et cetera, et cetera. And then you got the futures at the majority trade, which is going to be just regular futures indexes, index markets. So it's going to be NAS 100, S&P 500, and the Dow Jones. In a mini version, it would be called a mini index. Like you can look at the top left corner, it says mini index. It's a smaller version in regards of how much it costs to be able to buy a certain amount of contracts when it comes to how much you're risking of your overall account balance and et cetera, et cetera. Because it's a fractional difference compared to how much it would cost to be able to buy a specific contract size in the actual index markets. All right. So like it might cost for you to buy a full lot or one contract and just a regular NAS 100. Let's say it would cost $1,000. You'd have to have $1,000 minimum in your account to buy it. But when you're trading mini indexes, it kind of reduces how much you have to buy, but you also have to look at the risk wise, percentage wise, what you're risking, so then you don't go too overboard. All right, but that's the main differences are the market types. Now, again, the main markets future traders are trading are going to be what would be NAS 100, which is NQ, S&P 500, which is ES. Very few are allowed to, but you can trade what's called US 30, which is the Dow Jones. Now, for options traders, people who are in my Discord trade options or whatever, for options people, and Q would be QQQ because both of them are consistent of NAS 100, the index market. S&P 500, which would be ES, would also be SPY when it comes to options. And then US 30, Dow Jones, would be IWM. Meaning, for options people in my Discord, for people who are in options and want to join my Discord, since we aren't really doing much options wise at the moment anymore, that means essentially when we are trading NQES or US 30, we're going long or shorting, You could buy a call or a put, and regardless, it's going to end out with the same outcome. It's just the chart's going to look a little bit different because with the individual stocks, you have big old market open gaps compared to futures market, which is the main difference. It is a 24-hour market. 2-4. Meaning you could trade at any time of the day. You could trade at 1 in the morning, 2 in the morning, 3 in the morning, 4 in the morning. You could trade after market. You could trade before market open. It's a 24-hour market, all right? Just like Forex, essentially, all right? But those are the main differences. Now, when it comes to how you buy and sell, what do you buy and sell depends on your brokerage or prop firm. Majority of a futures prop firm or brokerage is going to go by what's called contracts, which you have two different types of contracts. You have just regular contracts, and then you have micro contracts. All right? Buying a regular singular contract is going to cost a lot more, and you're going to be risking a lot more of your overall account compared to a micro, because a micro, I believe, is 1/5 or 1/10 of the overall cost of one singular contract. Don't get too flustered by that. But that's how majority works. So like my prop firm, I buy it by contract. So I'll either buy one contract or multiple micro contracts. It really just depends on your brokerage and prop firm. Compared to this brokerage and some other brokerages, you might have to buy it by lots. So you might buy a micro lot, a mini lot, or a full lot. Depending on which one you buy will determine how much of your account you're risking, which will overall determine how much you can make/lose on either end of the market. All right. But those are the main differences in regards of futures. Now, when it comes to strategic stuff, when it comes to analytical stuff and everything like that, there is no difference. It's about the same thing, other than the main difference, which is there really aren't any per se market open and close gaps. Granted, yes, we do have some like over here and over here, which have the same significance within options, but they're not going to be super huge and drastic, and they're most likely going to be filled before you even wake up compared to options trading, meaning we actually have the ability to see structure and how it's moving instead of having a huge freaking gap, meaning we can see more, meaning we can understand more when it comes to where price is going to go within that overall direction. All right. But besides all that, boom, let's get to the charts. All right. So first thing that I do on a daily basis is I go to the daily time frame. Okay. Here is where I'm going to be looking at the overall structure long term, what we can expect price to do long term, because these are highs and lows that price will seek, take out, disrespect, and respect within a long term of a time frame, within a long term longevity compared to like the 1 hour or 2 hour. Those are highs and lows that price is probably going to seek within the day, the next day, or within a week, which is short term, what I consider short term. All right. So the daily time frame, we're looking at long term structure, and long term, we are still bearish as crap. You feel what I'm saying? Granted, we did have this peak upwards with all the news and everything that came out this week, but considering this big bearish candle and how we closed Thursday, because markets were closed yesterday on Friday, I'm going to shoot to say we're probably going to take out these lows on the daily time frame. Then we might form a higher low and spike further up, or we're going to seek these lows down below. It go further down to lows all the way back from frickin' 2023 of November. Wild. Freaking absurd. But I mean, hey, I got no issue waking up and just pressing sell and letting it ride. I got no issue with that. You feel what I'm saying? I missed the opportunity last month. I ain't gonna miss it again if it happens again. All right. But yeah, I'm gonna be looking at structure long term, what we can expect long term. Okay. Now, amongst that, there are two other things that we're going to be going to the daily time frame to do, and that's going to be one, marking out primary liquidity, which I'll explain in a second, and two, marking out structural levels, places based on consolidation and stoppage that, on average and statistically speaking, analytically speaking, price should stop at every single time it gets there. Not stop at, but it can either stop at and screw us over mid trade. Therefore, we need to know that it's there, or price can strongly break above or below that level, and we know that we can take a trade confidently within that direction. That's the whole point of marking it out, right? Whether you want to call it levels, support and resistance, whatever you want to call it, right? So obviously we already understand the structure long term, which is probably just going to be continued bearishness. From here, I do want to zoom out and I do want to mark out levels, okay? So here is where we're going to be looking at stoppage and consolidation. You see how many times price stops and consolidates within this overall area on multiple occasions. That lets me know that this is a strong area that price, when it gets here, is most likely going to stop there. and you see how price rejected perfectly and closed right below that, it lets me know that we have a really strong level there, and we will probably see price drop further down to those lows below, like I mentioned before. Also, we are on NQ, NAS 100, mini index, QQQ, whatever. All right. And basically, we're just going to mark those out. We're going to leave it at, again, once you drop to the lower time frames, this is all going to be severely stretched out. It's not going to be super compact, meaning it's not going to be blinding you when you're trying to trade. All right. Now, after that, now I want to mark out primary liquidity. Now, before I marked it out, what is primary liquidity and what is standard liquidity? What I consider and call primary liquidity, my own liquidity strategy, is what people might call a drawn liquidity, or they might call whatever. Essentially, it's an area that has a lot of liquidity because it's a bigger liquidity point compared to the smaller ones on like the 5, 15 minute, 1 minute time frame, meaning there's going to be more money, meaning price is more likely to seek that area without a doubt because there's more money. And when we have those specific places marked out and we see price moving drastically towards that direction, guess what we know? Price is clearly going to that big primary liquidity point because it's such a big point of liquidity with so much money at the top or at the bottom that there's no way that price is moving this drastically and isn't going to take it out. It would just make no sense. Not saying it couldn't, but it makes no sense. All right. So then we can have a better understanding price action wise. All right. So how we're going to do that is we are simply just going to mark out relative highs and lows on the daily time frame. And that's where we're going to leave it at on the daily. Now we're going to drop to the 4 hour, make sure structure is still respected in our overall understanding. Which it very much is. Obviously, we have equal highs at this SMT point, possible SMT point right over here. And then this is where we're going to be marking out the second primary liquidity point, which is going to be the 4 hour highs and lows. It's probably what we're going to mark out right there. And now we're going to drop lastly to the 1 hour time frame. Now, the 1 hour time frame, you see how everything's already stretching out a little bit. Now, going to the 1 hour time frame, this is where we're kind of just going to make sure that all of our levels are pretty consistent with what we can expect. And then we're also going to be looking at structural ideas in regards of breakouts, short-term structure, which is also where we're going to be looking at short-term structure, what we can expect within a shorter time frame, which, as we can see, we've obviously been forming higher lows but lower highs, meaning we do have a range of breakout. If you're in my Discord, you already know what the game plan is. But this is also where we're going to be marking out specific structural highs and lows that if price does break, we can expect price to continue within that direction, which is going to be these two red levels over here. Structurally speaking, if we break above this lower high, we're going to form a higher high, and we're probably going to rip further up to these liquidity points above. And the same idea, but obviously to the sell side, if we break below this higher low down here, we are most likely, if not most definitely, going to drop all the way down to these lows below. All right. We're going to drop to the 5 minute. All right. Now, look at that. Everything is stretched out. Our charts are completely filled. Granted, yes, we do have a handful of stuff, but the charts aren't completely filled. We have our levels within areas that we understand that price could either stop at, consolidate, reject from, or strongly break above and continue in that direction. And then we also have our primary liquidity points and our severe structural points marked out as well. Now, the reason why I changed the colors on those two different areas is because I want to make sure that anything with that red line is something severe, meaning the moment price gets there, we know we're going to see something, whether that's manipulation after a sweep or a strong breakthrough and a strong rip in that direction that it broke from. All right, that's why I marked it out red, kept everything else black. All right. So now we have that all marked out. This is where we're going to be marking out some POI zones, and then we're going to go back to the 1 hour time frame to mark out some higher time frame POI zones. Which a POI zone is a point of interest in a zone or an area, just like the levels that if price gets to, it can very much stop at and screw us over if we are in a trade, meaning we need to mark it out. Otherwise, we might get screwed over. All right. You can also mark out the standard liquidity as well, the minor liquidity points. Now we're going to look to the left, see if we got any POI zones. We do have a fair value gap, which I'll go over briefly how to mark that out, because I don't have a video on that. Essentially, a fair value gap is going to be a 3 candle segment that leaves a gap in between. Now, there's a lot of people that get confused by that. And obviously, there's only really one example that you can show, which is price should do this candle segment every single time right here. So you see how this 3 candle segment had a candle, 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 and the middle candle, the second one, had a wick and then a wick. Compared to this 3 candle segment, how we had candle, 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 but the wicks did not fill in the body of that second candle. If the wicks of the first and the third candle do not fill in the body of the second or middle candle, and it does this, which is candle, 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 and the wicks do not fill in the body of that second candle or middle candle, that means that there's an imbalance, a quote unquote fair value gap. And that's really it, at least lower time frame POI zone wise. Obviously, we do have these imbalances, but price is most likely going to rip through those. Not even a question. Other than this demand zone, okay. Now, what is a demand zone and what is a supply zone? You see these huge and impulsiveness. That's the word, impulsiveness. When you see these huge drastic candles like that, you know what that leaves behind? A demand zone, and vice versa when it comes to impulsiveness to the sell side, that makes a supply zone. Okay, now not every single huge impulsive move is going to form the correct specific demand zone per se, but it should on average. So like here, you could mark this out as a demand zone considering the impulsiveness. And I mean, look what price did as soon as I tapped into it. Immediately rejected and shifted all the way back up. That would be a supply. That would be a demand zone. Okay. More in depth of what a supply and demand zone is. A supply and demand zone is an area where there are going to be a lot of orders because of the impulsiveness within that area. There are going to be a lot of orders from big banks and institutions within that zone, within that area of interest, that when price pulls back and taps into it, guess what gets triggered? A lot of freaking orders. And that's why you see so much impulsiveness when price taps into it and then shifts all the way back up, as previously shown with that example. So we have those lower time frame demand zones. We don't really have anything on the lower time frame with supply zones. A supply zone is the same as a demand zone, but vice versa. Actually, that is a lie because we have a supply zone right here. Now, majority of supply zones and demand zones, you would primarily want them to be a different color, and also smaller compared to the impulsive candle. Granted, this candle is smaller than this impulsive candle, but it isn't a different color. Doesn't mean that this couldn't be still a supply zone, as we can see how price tapped into it and dumped all the way down, tapped into it and dumped all the way down. This lets me know that this is most likely a supply zone. Okay, so we'll call that a possible supply zone compared to the rest down there, or possible to 100% demand zones. Regardless, mark it out so then you understand what you're looking at so you don't get screwed over. All right. And then the last thing that we're going to be looking at with my 5 minutes left is higher time frame POI zones, which we do have a supply zone. This is a perfect example of what I'm talking about. We have 2 different color candles right here, the impulsive candle and then the candle before the impulsiveness. That's the one thing I forgot to mention, is that supply and demand zones need to be based on the candle before the impulsiveness, meaning that when that impulsive candle comes, you mark out the previous candle from its high point and low point. Whether it's a full body candle and you mark out the top or the bottom, or it has wicks on both ends, you mark it at the bottom wick and the top wick. Regardless, you mark the top and the bottom of the previous candle to the impulsive candle. See how I marked the previous candle to this big impulsive candle? Like that, okay? And this is clear as day, 1 hour supply zone, because look how price rejected and dumped all the way down each and every single time it tapped into it. You see what I'm saying? It's not going to happen every single time because just like every strategy, not every single strategy works every single time, but there is a good chance, statistically and analytically speaking, that it could happen. And really quickly, because I forgot to mention it earlier, which is the biggest and most important thing within trading, is market structure. That's the main thing. The main thing that influences my trades is structure, because markets should respect structure in whatever direction that may be. Now, if you don't understand market structure is literally all of this. When price is in a bullish structure, that means we should be forming higher highs and higher lows, higher highs and higher lows. And in a bearish structure, we should be forming lower highs and lower lows, lower highs, lower lows, lower lows, lower highs, etc., etc. When price disrespects this structure by forming in this bearish trend, how we formed a higher high when we should have been forming a lower high, because in bearish structure, we should only be forming lower highs and lower lows. The moment price starts shifting by forming higher highs and higher lows, that lets us know by breaking these right here, this lower high here, that lets me know that we are most likely going to shift to the buy side. And then guess what price did? Formed another higher low, swept liquidity over here, pushed all the way upwards, okay? And then vice versa with the sell. And then same thing with the buy side is that when we are in bullish structure, we should be forming higher highs and higher lows, meaning the moment price starts forming lower lows and lower highs, that means we are going to be shifting to the sell side because price cannot disrespect structure without any sort of implication of a reversal and shift and change in character of its overall direction, which is why you see price going from bullish structure like we see here to disrespecting it by forming sell side structure and then dropping all the way down, and then shifting from sell side structure to buy side structure by forming higher highs and higher lows when we should be forming lower highs and lower lows, and vice versa. This is the most important aspect that you need to understand and master within trading. Otherwise, you will not know where price is going to go, regardless of what POI zones you have, regardless of what liquidity you have marked out. And yeah, I mean that's basically it. We went to the higher time frames to mark out primary liquidity and mark out specific structural levels. We went to lower, higher time frames to mark out more POI zones, any other levels, and any other higher primary liquidity points. Then we went to the lower time frames, marking out any lower time frame POI zones and liquidity and possible levels within the area. Meaning we now have an overall setup. We know where we can take trades off of, and we know where we can take trades to. We know what's in the way that could stop us and screw us over, and we know what's in the way that could help us introduce us into getting into a trade. Meaning price could easily come up here, form a lower high, reject, and we could take it all the way down. Price could dump all the way down, tap here, shift to bullish structure in the lower time frame, where we could take a trade all the way up, whatever, or price can break through, and then we can wait for a breakout, retest, take it all the way up, and vice versa to the sell side, because we know what's in the area that could screw us over and what could help us out. That's the most important thing. But that's basically everything I do. And, I finish on my weeks and months on average, which I give all praise and all glory to God, with a 70 to 100% win rate. Again, give all praise and all glory to God. But this is what I do. A lot of people ask me, do I trade ICT, SMT, woo, I don't. I trade specific concepts that I know work, at least for me, and specific, genuine understanding that works, period, like market structure and liquidity. And I let that fuel my trade. When I understand market structure, I understand where price should go based on structure, analyticalness, and statistically speaking. And then marking out the liquidity lets me know that based on price action, where price is going to clearly seek, what liquidity point price is clearly looking to seek towards. And then the POI zones are just going to be there, so then you understand where price could stop at and screw you over within a trade, or you could possibly take a trade off of. That's the only implication and only reason why POI zones are marked out, is so you don't get screwed over and so you could possibly take a trade off of it. That's the only reason. All right. And yeah, well, I hope the video was helpful. Obviously, this is just what I do. This is just how I trade. You feel what I'm saying? Some people, they learn from me, they master it, they get it done just like me. Some people, it just doesn't work with them. Not every strategy is going to work for everybody. This is just what I do. It works for me. If you don't like it, that's cool. I'm not saying I'm the best trader. I've never claimed to be the best trader. I never claimed to be the greatest trader, the most successful trader. Never have. I do what I do because it works for me and it works for everyone else who I've taught. Sometimes it doesn't. Again, not everything works for everybody. Everybody runs mentally different. You feel what I'm saying? But if you like the video, tap the little sub button, tap the little like button, tap it to the Instagram, tap it to the TikTok, tap it to the Discord, everything. And yeah, God bless y'all, and I'll see y'all next time.